Week one is over. And here's what it actually cost you. Not what it cost the government. Not what it cost the oil companies. What it cost you sitting at a kitchen table, filling up a car, buying groceries, paying a mortgage, planning a retirement. That's the number nobody is calculating clearly right now. And it's the number that matters most. 7 days ago, the world looked completely different. Brent crude was sitting at $70.78 per barrel. The Federal Reserve was close, finally close, to cutting interest rates after 5 years of fighting inflation. The IMF had just published its global growth forecast at 3.3% for 2026. Healthy, stable, the kind of number that lets ordinary investors breathe. Then Operation Epic Fury began, and in 7 days, Brent crude settled Friday at $92.69 per barrel, up 28% in a single week. That is Brent's biggest weekly gain since April 2020, when the entire world economy shut down during a pandemic. WTI crude, the American benchmark, surged to 90 cents per barrel on Friday, posting a 35.63% weekly gain. That is the single largest weekly gain for WTI futures in the entire history of the contract, going back to 1983. 43 years. Nothing has ever moved like this. Not the Gulf War, not September 11th, not the 2008 financial crisis, and you're living inside it right now. Because week two is where the real financial decisions get made. And the second to last section of this video contains a specific historical pattern from 85 years of market data that changes how you need to be thinking starting today. Don't skip it. Let me tell you what week one actually did to your daily life first, before we get to portfolios, markets, and strategies. Because this is where most financial coverage fails ordinary people. They talk about futures contracts and basis points. They don't talk about your table. The average price for a gallon of regular gasoline in the United States jumped nearly 27 cents in a single week to $3.25. That's the fastest weekly price increase American drivers have seen in years. In Europe, the picture is worse. Germany's largest automobile association reported gasoline and diesel prices jumping double digits in 7 days. The fastest weekly fuel price increase in over 2 years. And that's just what's happened so far. Qatar's energy minister Saad al-Kaabi told the Financial Times on Friday that crude prices could reach $150 per barrel in the coming weeks if oil tankers remain unable to move through the Strait of Hormuz. That's not a fringe prediction. That's the Minister of Energy for the country operating the world's largest liquefied natural gas export facility, a facility already halted by this conflict. Iraq has shut down 1.5 million barrels per day of production. 2 Iraqi officials confirmed this to Reuters this week. Kuwait has started cutting production after running out of storage space. The Wall Street Journal reported Friday that Kuwait's situation could deepen further as the week continues. J.P. Morgan's head of global commodities research, Natasha Kaneva, told clients in a Friday note that production cuts could approach 6 million barrels per day by the end of next week if the Strait of Hormuz remains closed to traffic. To understand what 6 million barrels per day means, the entire world currently consumes roughly 103 million barrels per day. A 6 million barrel cut is roughly 6% of global daily supply. Gone. Simultaneously, in the matter of days. The last time a supply shock even approached that scale was the 1973 Arab oil embargo. And that one sent the global economy into years of inflation that still shapes financial policy thinking today. This is what I call the week one tax. It doesn't arrive in a letter. It doesn't show up as a line item. It distributes itself quietly across your fuel costs, your grocery bill, your heating, your mortgage rate, and the borrowing costs of the businesses you work for. For families already stretched after 5 years of post-pandemic inflation, the week one tax lands on a foundation that was never fully repaired. The people who understand this don't panic. They plan. And planning starts with understanding exactly what the next phase looks like. Here is the only question that determines everything about your financial life over the next 6 to 12 months. And almost nobody is asking it correctly. Everyone keeps asking, how high will oil go? That is the wrong question. The right question is, how long does the strait stay closed? Bank published a detailed analysis this week with two distinct scenarios. In the first scenario, the one markets were partially hoping for at Monday's open, U.S. and Israeli strikes hit Iran's fixed military infrastructure, operational tempo slows within weeks, a de facto ceasefire emerges, and the strait reopens. Oil stabilizes. Chatham House estimates 0.5 percentage points of additional inflation in this scenario, with growth dipping only modestly. Central banks hold rates, but don't raise them. Life becomes more expensive for one quarter, then normalizes. In the second scenario, the one J.P. Morgan's commodity desk is now openly preparing clients for, Iran doesn't surrender. Trump's Friday demand for unconditional capitulation goes unanswered. Iran fights asymmetrically. Continued harassment of tanker traffic. Sustained strait disruption. Production cuts cascade from Iraq and Kuwait across the Gulf. In this scenario, $100 to $150 per barrel isn't a forecast. It's arithmetic. Remove 6 million barrels per day from global supply, and the price mechanism does the rest. Goldman Sachs told clients this week that if oil holds at current levels through year-end, U.S. consumer price inflation rises from 2.4% in January to 3% by December. Former Treasury Secretary Janet Yellen said Monday that the war puts the Fed even more on hold and more reluctant to cut rates. Nomura's economics team stated plainly that the ongoing conflict solidifies the case for central banks to hold rates steady. What does that mean for you in plain language? The rate cuts you were expecting this year, the ones that were supposed to ease your mortgage, your credit card interest, your car loan, are now on hold, possibly eliminated entirely for 2026. The Bank of England, which was on the verge of another cut as recently as last month, now faces the same impossible question: cut rates to protect a slowing economy, or hold them to fight the inflation that war just reintroduced into a system that was almost clean. Two scenarios, one question, and the Trump administration's Friday move announcing a $20 billion insurance program for oil tankers in the Persian Gulf tells you everything about which scenario they're worried about. Because you don't build a $20 billion insurance backstop for a conflict you expect to resolve in days. Now, here's the thing about week one that almost nobody in financial media is covering properly, and it comes from 85 years of market data. Strategists at Carson Group compiled 40 major geopolitical and historical events going back to 1941. Germany invading France, the Korean War, the Cuban Missile Crisis, the 1973 oil embargo, the Gulf War, September 11th, the 2008 financial crisis, the COVID-19 crash, 40 events across 8 decades, and they measured what the S&P 500 did in the aftermath of each one. The average return in the first month after a major geopolitical shock, negative 0.9%. The average return across the following 6 months, positive 3.4%. 6 months after the shock, markets had not just recovered, they had grown. Not every time, not in a straight line, but consistently enough that the pattern cannot be dismissed as coincidence. David Stubbs, chief investment strategist at AlphaCore Wealth Advisory, told CNN this week that we know usually when there's conflict around the world, it doesn't go on to materially impact the direction of U.S. corporate profits, which are the lifeblood of the equity market. I've watched this pattern play out in real time 4 times in my investing life. The Gulf War in 1990, September 11th in 2001, the Iraq invasion in 2003, the COVID crash in 2020. And every single time, the investors who suffered most were not the ones who had the wrong assets. They were the ones who made permanent decisions based on temporary fear. They sold quality holdings in week 1 or week 2 when uncertainty was loudest, and then watched the recovery happen without them. Now here's the critical nuance. This conflict is different from those 4 in one specific way. This is a direct U.S. military operation, not a market shock caused by external events. And the oil disruption is not a fear premium. It's an operational reality. Iraq has already cut 1.5 million barrels per day. Kuwait is cutting. J.P. Morgan has 6 million barrels per day in their risk scenario. When supply physically leaves the market, not just gets threatened, the economic math is harder than usual. What that means is the 85-year pattern still applies to quality equity holdings, but it does not apply to pretending the energy shock will resolve painlessly in 2 weeks. These are two different conversations. The investors who hold both truths simultaneously, market recovery likely over time, but energy pain real and near term, are the ones who make the clearest decisions right now. You deserve decisions based on that record and that nuance, not based on what's loudest on social media this afternoon. 3 actions, specific, starting today. The first action is for cash holders, and right now there are millions of them. If you are sitting on savings in a standard checking or current account earning close to nothing, the week 1 tax is taking from you silently right now. Goldman Sachs has inflation moving from 2.4% toward 3% by year end. Cash earning zero loses real purchasing power every month this drags on. The 3-month Treasury bill through Treasury Direct is currently yielding 3.6%, full U.S. government backing, fully liquid at maturity. Top high-yield savings accounts are paying 4.09% according to this week's bank rate data. For UK investors, a competitive cash ISA preserves your tax-free allowance, while your money actually competes with the inflation heading your way. This is not an investment decision. It's a maintenance decision. Don't let inflation quietly claim what you worked to save. The second action is for investors watching their portfolios fall and feeling the urge to sell everything. Financial advisors at Ritholtz Wealth Management reminded their clients this week that while wars can last years, most people's investing time horizon is measured in decades. The question is not what happens to your portfolio this week. It's what happens over the time horizon you actually care about. If you hold a diversified portfolio of quality businesses, companies with real earnings, real pricing power, durable balance sheets, the 40-event 85-year record says your job right now is to stay in the seat. Panic selling in week 1 or 2 locks in losses at maximum fear before the recovery that history suggests follows. The investors who built lasting wealth through every crisis on that list were not the ones who moved fastest. They were the ones who moved least. The third action, and this is the one most people skip entirely, is to make sure the week 1 tax can't force your hand. If you don't have an emergency fund covering 3 to 6 months of living expenses, a sustained period of higher fuel costs, higher food prices, and higher heating bills could push you into selling investments at the worst possible time. Not because you chose to, but because your budget left you. No choice. A cash buffer in a high-yield account or a cash ISA sitting separately from your investment portfolio means you absorb the economic shock on your terms. That buffer is not idle money right now. It is the most active financial protection you own. When you set that buffer up, when you make that decision deliberately this week, instead of in a panic 2 months from now, you stop being someone reacting to what this war cost you. You become someone who already decided it wouldn't. Save this video. Come back to it as week 2 develops and the 2-scenario framework becomes clearer. Short conflict or sustained economic warfare? That question will make every headline between now and summer make sense. Subscribe to Warren Buffett University for the financial thinking that actually works when the world gets loud. Iran war, week 1 market impact.
Brent crude $92 analysis. WT biggest weekly gain in history. Oil price forecast 2026. JP Morgan's 6 million barrel warning. Iraq production cut impact. Strait of Hormuz economic effect. Federal Reserve rate cut eliminated. Inflation 2026 rising. Carson Group 85-year geopolitical study. What to do with savings during war. How to protect your money from inflation. Cash ISA during inflation spike. Treasury Direct T-bill strategy.
Emergency fund war inflation. Smart money week 1 decisions. S&P 500 geopolitical recovery pattern. Roth IRA during conflict. The most expensive financial mistakes I've seen in 60 years of investing were never made by people who weren't paying attention. They were made by people who were paying too much attention to the wrong thing, the noise instead of the pattern. This week has more noise than most. Find the pattern anyway. You stop being someone who reacts to what war costs you. You become someone who decided in advance what it won't.